this race of accumulating metals and other commodities even is just at the beginning in my view. And I think we're going to see prices of metals that are likely to surprise everyone. I do think that the US is getting close to some radical changes in its policies. Their openness to talk about Bitcoin, imagine what's happening closed doors when it comes to gold.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 27th through February 3rd, 2025, while supplies last. This week, backdated 1-ounce silver Austrian Philharmonics are just $2.85 over spot, one of the lowest prices we've had on a sovereign coin in years. Next, AU pre-1933 $20 gold St. Gaudens coins are just $50 over melt. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We are delighted to have this returning guest today, who it's my first time to interview. Tavi Costa is a partner at Crescat Capital. He joins us this Thursday, January 23rd, 2025. Tavi, thank you for joining us again here on Liberty and Finance.
Thanks for having me. Looking forward to this conversation.
Our audience knows you well as a sound money advocate, interested in precious metals and commodities and other real things, and also a keen observer of financial markets around the world, including the currencies such as the US dollar. A lot of our viewers are seriously concerned about destruction of their purchasing power, basically their earnings, savings, and retirement being stolen from them through the pernicious effects of systematic and grinding inflation by design that eats away at the value of their dollar. Can you talk to us about your latest studies of the relationship of the dollar to real things such as commodities, etc., but also to other currencies around the world, and what people need to know that you're finding out from your research?
Yeah, I think, back in 2018, 2019, we've had a big changing views about commodities, mostly coming from what was happening in terms of the producers and the capital spending in this whole industry of resource industry overall. That kind of shifted to being very bullish on resource prices. We just didn't know which commodity we should be expressing that view. That then led us to mining because of the duration of this industry that tends to take about 10 to 15 years to see new supply, which also, and I'm just sort of kind of explaining how we got into tangible assets that, just gave us very high conviction that ultimately we were about to see a commodity bull market, and that tangible assets, particularly commodities, would benefit tremendously. After seeing all this and starting to unfold, we've been in sort of a rotational dynamic for commodities, of which there's always the flavor of the month, and that tends to see or experience a large surge in prices that is then shifted towards a second commodity or another commodity later on. But what is more interesting is that the later stages of this evolving research is that when I learned that the US was spending about 4 to 5% of its GDP just to pay down taxes or to service the debt, I think this is well known by most the community of investors, but what they tend to dismiss is the fact that there's not a single economy in the world that is large like the US or developed as the US that is currently paying anywhere close to those amounts. Even countries like Japan that are highly levered are only paying less than 1% of their GDP when it comes to the amount to service their debt. And, learning from the UK era in the 1800s, one thing was clear. It wasn't necessarily, a lot of people, again, dismiss this fact. It wasn't necessarily the amount of debt relative to GDP that led to the destruction of their monetary system at the time and the change of the global reserve currency status of the time as well. What really led to that was the issue with this growing pressure of the interest expense relative to GDP. And ultimately, that is essentially what causes countries to restructure their debt or get to a moment where they're just forced to suppress interest rates in order to survive. And so I think we're getting to that point. I think a 4 to 5% of GDP level is something we have never seen actually in a very long time. And I would suspect that we're getting very close to a very significant cut of interest rates in the US that is not justified by inflation falling, that is actually just justified by the fact that the government is broke. And ultimately, that is what drives the US dollar lower, not higher. And there's more to this, but this is the gist of the whole, the essence of this thesis that the dollar is, very overvalued relative to other fiat currencies as well.
That's been rather impressive over the past quarter or so, the relative rise of the dollar compared to other fiat currencies, given the dire debt spiral that the U.S. seems to be in. In fact, the first 2 months of this fiscal year, which started in the fall, actually were the worst two on record for the United States in terms of additional debt. And all through last year, it was approximately every 100 days we added another $1 trillion in debt and to the money supply that has nothing behind it. Can you talk to us about the implications of that going forward? As you mentioned, it has not played out well for countries that do that and try to maintain the world reserve currency status at the same time.
Yeah, and by no means I think we're at the moment where we're going to see a shift to another currency to become the reserve currency status. But I do think that in order to maintain that status, the U.S. almost requires the U.S. economy to weaken its currency. After listening to Trump closely and listening to his views about currencies over the years, it is also evident to me that he's very much of a guy who likes to pursue a weaker currency path, despite the fact that he wants to have the global reserve currency status, of which Scott Bessent, his Treasury Secretary, has stated that those two things are not mutually exclusive. In other words, that they can happen in tandem, of which I agree with. And so I'm paying close attention to this because the world is being suffocated by what you just mentioned, which is the rise of the US dollar. If the US economy wants to continue to grow, we have to rebalance things. We have to take dollars to other places outside of the US. And that ultimately is what drives growth outside of the US as well. That drives the global economy, and everybody's happy. But, we saw this as a coordinated act back in 1985 through the Plaza Accord. Is this the Mar-a-Lago Accord that we're on the verge to see? Potentially. I think either organically or coordinated, the dollar appears to be nearing a significant turning point. And a turning point that we tend to see every 10 to 15 years. When you take the DXY index, which nothing else is nothing more than taking the dollar relative to the euro, relative to the British pound, relative to the Japanese yen, and others. When you take that basket index, what you find is that over a course of 10 years of performance, you tend to see very long-term cycles for the dollar. And clearly, looking at that chart, the DXY 10-year performance has been rolling over recently, despite this surge that we've had over the last a few months. And I am of the view that we're going to see two things. And those two things are almost the perfect combination to destruct the strength of the dollar. Those two things are weaker fiscal spending and also very likely to see suppression of interest rates. Notice that those two things work together. In order to reduce fiscal spending, you need to suppress interest rates. That's the easiest route to reduce fiscal spending, assuming that 4 to 5% of GDP is being used just to service the debt. So by reducing rates, you accomplish both things. And Druckenmiller said it many times in interviews in the past, particularly in the 1990s when he was very, had some very big calls in currencies. And one of the things that he said is, the combination of strong tightening monetary policy along with aggressive fiscal spending is perfect for the US dollar, especially when it's done on a relative basis as well, relative to the European economies or relative to Japan or Canada or Australia. And I think we're about to see the opposite of that. We're about to see, very significant monetary loosening despite the fact that inflation remains elevated. And on top of it, I think has been a clear pressure from different, not only the households and the population, but also the new administration to reduce fiscal spending as well. And I think the combination of those two things is quite destructive for the US dollar relative to other currencies. So I guess that sums it up why, I think the dollar is at a very dangerous zone right now.
It's interesting because many observers have been claiming that the dollar, as far as the eye can see, relative to other currencies, it's been showing so much strength lately, and that's likely to continue, etc. It's an interesting viewpoint that you're bringing out. Can you tie that in with something else that you touched on earlier about your interest in real things, including commodities? Because typically when the currency is falling, we see that exhibited in higher prices of nominal prices of real things, such as commodities and precious metals, for example. The geopolitical picture that we're looking at with Trump coming in has had a lot of, you could call it saber rattling or threats of tariffs or retributions against other countries, including applying large import penalties on bringing in of foreign materials. And there are strategic materials that we need in our country and in our growing economy, many of which are dominated globally by China. So what's the connection that you anticipate between a falling dollar and at the same time restrictions on imports or tariffs on imports that could drive prices higher?
Yeah, I mean, the world is becoming more and more deglobalized, which tends to benefit commodities, given the tensions that we also tend to see because of the level of debt in the world and tensions overall. And look, in my view, when you reach these levels of leverage globally, the only way out is that is less painful. Both places are painful, both routes are painful, but the less painful one, that is usually the path of least resistance, is inflation. I've never seen in history an inflationary era that is not accompanied by hard assets doing very well, because at the very essence of the word inflation, one of the things that comes to mind is the depreciation of a fiat currency relative to hard assets. That is what causes inflation, essentially, is the dilution of money, of fiat money, relative to real things. Gold has been the leading that pack when it comes to assets that have been benefiting from this environment. Some would mention Bitcoin. But when you're really thinking about the commodity space, there's a lot more in terms of opportunity, in my view, to play out. I mean, consider some other ideas. For instance, what we're seeing with the AI revolution. The need for restructuring the entire grids of the U.S. and other economies in order to support these data centers that are in nearby cities and will become very disruptive for their own electricity consumption. This is going to be a problem. And the only way to fix this is actually completely rebuilding or grid infrastructure in the U.S. economy and also other places. That requires materials, particularly copper. And so it's hard to not be bullish in those parts of the market, especially when you also look at positioning. how much do pension funds own of commodities? How much do family offices own of commodities outside of even gold? And in my view, it's very clear that these large institutions that tend to drive prices because of their capital flight tends to actually have an impact in prices overall. Have not happened yet. So there's also the potential for that to shift. I would also point out another trend that is incredibly relevant, which is onshoring. A lot of people talk about onshoring in the U.S., which is certainly happening from Trump's standpoint, and you're seeing Trump trying to bring back manufacturing and in this whole focus towards tariffs and trying to really make sure that the builders of the U.S. are in a position to do their job. And what I find it interesting is that not a lot of people are talking about the onshoring happening in other countries, Japan, Europe, Canada, Australia. So there's a global trend of onshoring that just means bringing dollars back, or a currency, their capital back to their own countries. That is at its nature as well means that those countries are going to be selling dollars to bring capital back to their economies to be spent locally. And so I think all that is going to have an impact in the dollar trend, but also will create an incredible potential for some of these markets to do very well. So I can't help but be very optimistic about commodities. I can't help but be very optimistic about where I think gold is going to go, because of the imbalances that we have currently are going to lead to that, in my view. And number three, which I think is potentially one of the most important things as well, is this rebalancing that it's happening likely from U.S. markets to the rest of the world. Think about what's happening with the MSCI index that has a 70+% weight in U.S. equities, and essentially the remaining side of it is all in the rest of the world. Or think about that the U.S. market has a larger market cap than the entire rest of the world global equity market. All these things are getting to a degree of imbalance that I think it's quite extreme historically. Perhaps we have never seen this before. It's actually funny to see people talking about American exceptionalism when we've been seeing American exceptionalism at a degree that we've never seen in the past. And calling it that's going to start today or with this new administration seems very off from what we've been experiencing historically. And so I really believe that not only tangible assets will do well, the dollar will have a very difficult period for this coming decade. And I think we'll start this year. And thirdly, I think as part of all these things unfolding, I can't help but be extremely bullish in the rest of the world in terms of equity markets, housing markets, and other things. I like Latin America as my favorite region to invest. I think that's an area that has abundance of resources and also tends to be quite neutral outside of a few countries when it comes to geopolitical relationships, and ultimately would be an area of the world that is likely to benefit tremendously from all these changes that we may see in the coming decade.
What about strategic materials that are not generally distributed evenly around the world, that the United States has taken for granted, and frankly many countries may have taken for granted in the era of globalism and where offshoring was the rule of the day for the past maybe 4 decades, where you could obtain materials from anywhere and you could process them anywhere and you could have these long global supply chains and it all would somehow magically work out. We found that all came crashing down during the COVID era when supply chains were breaking all over the place. But now with these geopolitical tensions, there's also some sides being taken, led perhaps by China's strategic relationships with certain countries around the world to tie up and lock up strategic materials. Can you talk to us about those commodities that are not evenly distributed, but that are in critical need for the U.S., but might not be within the realm of our reach?
It's very true. Authoritarian regimes in particular are taking the approach of paying above and beyond in terms of valuations for mining projects to secure metals at all cost. And that's also a very scary move from a geopolitical standpoint. I think it's scary what's been happening on that front, particularly, again, when you think about the capacity for refining metals overall, which is almost entirely coming or dependent on China today outside of iron ore. And so that concerns me in a big way. I do think that's a problem. I think also this idea that we're likely to see just a total disconnect between the U.S. economy and other parts of the world, such as especially the China and other authoritarian regimes. I'm not of the belief that we're going to see a complete disconnect of those two countries. They're going to have to cooperate in some level. In fact, I would suspect that what Trump has been doing with Greenland and the Panama Canal is essentially a way of him to negotiate what seems to be the inevitable, which is China taking over Taiwan, and Trump not willing to give up on that without pursuing his own agenda. And so, when you start moving lines in maps and securing metals at all costs and all these things, the world gets a little bit scary from that standpoint. I can't help but pay attention to even ourselves, that we sell, we're the owner of the 5th largest silver producer in the world. And what we are experiencing in terms of us selling concentrate of silver to Chinese parties at a major premium to what the market is buying those metals for. And so it is. Look, it's an interesting place we're in the world. To me, it has never been so clear from a macro high conviction view that there are a lot of things to be considering when it comes to allocating capital. A lot of things have been kind of ignored and neglected for a very long time. And valuations have a very large disparity with things that have been very popular, like technology companies and other things that have been mostly taking over the news, and crypto and all sorts of things. And I think that's really what creates a lot of value opportunities for investors. And so, I'm very bullish in all these things, and I do think that this idea that countries are paying above and beyond to secure commodities is a trend that will be not only be used by China and Russia and others that are more authoritarian leadership but also from Western societies, that when they wake up, that they need to level the playing field by even providing subsidies or acting on behalf of private buyers of these projects. I think that's when you start seeing the real bidding war for mining companies and all sorts of other resource businesses that are likely to be in a very high demand in the future.
You mentioned in passing a couple of times countries paying whatever it takes around the world to get their hands on strategic materials, or in some cases, commodities, including metals of different types. We've heard stories, and some from mining company executives, that many of the countries of the world that are amassing supplies of these materials, for example, silver, are doing so not off the major commodity exchanges like the COMEX or the LBMA, but by working directly with mining companies to get doré and unrefined or semi-refined material and bringing that back so that it doesn't perturb the price. Well, for a lot of reasons. First, just to get closer to the source so that you have a source of it. Secondly, to establish that relationship. Third, to do it kind of clandestinely in a way that doesn't necessarily perturb the price on the exchanges and make it so obvious to everyone what you're doing. Can you give us any insights that you have into the study of what's been going on in this chess game of countries trying to lock down sources of supply of scarce resources?
Yeah, I probably one of the things that have been happening. Look, I spoke more directly about silver because I've been involved with that. I've also been involved with zinc and lead, that we've experienced similar transactions where, for instance, Chinese parties paying significantly more than market prices to secured metals. But this is clearly happening in the gold space as well. Gold, it's almost funny to me to see this euphoria towards crypto, and it makes me wonder who created this whole space and who really initiated Bitcoin and all that, given the fact that we don't know who did it. Because it's almost like a perfect way to distract the Western societies from the bigger picture of really owning a hard asset like gold in order to protect its monetary system. And so there are a lot of big negotiations happening, that are under the table, or I should say off the radar, it's a better term, that I don't think people are necessarily fully paying attention to. One of them that I'm referring to is what central banks have been doing in terms of accumulation of gold. When you look at the price of gold itself, it's hard to justify this move we had over the last year and a half by just calculating it by looking at Western investors and others that have been reported as buyers pushing up the price, because that is not in line with the type of movement we tend to see in terms of volume. And so there has been a lot of buying that is, as you mentioned, outside of the what's been calculated when it comes to indices and other exchanges that tend to track those things. And that's quite concerning. And I would say, I'm paying close attention to what the U.S. is about to do, because I do know Trump is a big fan of gold and he's playing this Bitcoin game. But one thing I learned in my life is that when you do want to buy a significant amount of a certain commodity or a certain asset, what you don't do is announce to the whole world that you're going to do it, right? You buy it and then you tell the world, this is what I've just done. And I find it interesting, the fact that people are looking at this whole story about, and again, it's nothing against Bitcoin. I just think it's missing the big picture here of what gold really is, what gold really means to this whole setting of, really historical levels of leverage that almost forces economies to accumulate the metal to enhance the quality of their international reserves. And I do think that the U.S. is getting close to some radical changes in its policies in order to do that. Their openness to talk about Bitcoin, imagine what is happening closed doors when it comes to gold. Scott Batson, the Treasury Secretary, if people don't know, and again, a lot of people don't like to talk about him just because he worked for Soros, but pay attention to what he's doing. His largest position right before taking this job was gold. Wasn't Bitcoin, wasn't oil, wasn't silver, was gold. That doesn't mean other commodities and other things shouldn't do well. All I'm saying is clearly there's a understanding of the history and the credibility and also the reputation of the metal, of being able to act not only as a safe haven, but truly as an anchor to a falling monetary system like the US dollar and other fiat currencies. And so this race of accumulating metals and other commodities even is just at the beginning, in my view. And I think we're going to see prices of metals that are likely to surprise everyone, not even myself. No, I'm as bullish as you could be, and I think I would be surprised at the end of this era, and I'm probably going to be the one selling it early. So that's my 2 cents. How do I hold myself, to avoid such a tragedy of selling what I think is one of the best ideas to take advantage of, given the imbalances we have globally. They're almost like a natural escape valve that allows commodities to perform incredibly well. And I think this is a very unique, moment in history that we're living. And when people use that word unique to say a lot of things that are with very low conviction, saying, well, it's going to be a period of a lot of volatility. Yeah, but there's a lot of opportunities that will likely emerge from this, and one of them is hard assets. And so I cannot stop thinking about what is the best way to express that view in the markets. Is it oil, for instance? Look at oil prices today relative to, if we had a plot chart of oil prices versus risk of a World War III environment, which I think is significantly higher than it was 10 years ago, 5 years ago, 20 years ago. And relative to oil prices, that is an outlier. Oil is a commodity that perfectly reflects that level of risk. And today it's just not reflecting that because everybody's thinking about drill, baby, drill, but, they're just not drilling yet. And I think it's interesting because those are the types of scenarios that create opportunities. And as a contrarian and an investor in macro assets for a long time, I think that's what creates the perfect storm for those things to do very well.
Tavi, if people want to take advantage of your ongoing analysis of this situation, how should they stay connected with you?
They can stay connected with me through Twitter at Tavi Costa, or also they can find our website, crescat.net, where we post a lot of letters and research there as well. But I'm very vocal of my views on Twitter. I should say X nowadays, but I tend to share a lot of my opinions there as well.
Our subscribers and viewers would do well to keep their ear tuned to your observations, I think, because you're looking at things that they've been paying attention to. And frankly, it's been difficult to keep your eyes on the ball when there are so many what seem to be distracting countercurrents that are happening at the same time. Folks, if you don't want to miss a single episode here on Liberty and Finance with Tavi from Crescat Capital, make sure you're on our free mailing list at libertyandfinance.com. Just put your email address in, click submit, and make sure you confirm. When you get the confirming email, you'll get 1 email per day, including all of our interviews with Tavi and all our other guests, as well as any weekly specials. Tavi Costa, partner at Crescat Capital, thank you for joining us again on Liberty and Finance.
Thanks for having me.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for January 27th through February 3rd, 2025, while supplies last. This week, backdated 1-ounce silver Austrian Philharmonics are just $2.85 over spot, one of the lowest prices we've had on a sovereign coin in years. Next, AU pre-1933 $20 gold St. Gaudens coins are just $50 over melt. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.